Welcome back to Outside the Dollar. I'm Elena Reyes. This week feels like four separate storylines are colliding at once. The Fed's weighing whether inflation's cooled enough to justify a pause, even as oil prices tick back up. At the same time, questions are piling up about who's actually financing this AI buildup and whether the money trail looks familiar. Add in some market warning signs flashing red, plus gold and silver pulling back hard from their recent highs. That's a lot to sit with in 1 week, so here's the plan. We'll start with the Fed meeting and what actually matters beyond this single decision. Then we'll look at the market pressure points stacking up, margin debt, yields, oil, and why they don't just cancel each other out. After that, we'll get into the AI financing story and whether the .com comparisons hold up. And we'll close with the metals pullback. Is this a reset or something bigger? Rightening, let's start where the market's attention already is, the Federal Reserve. Four stories are colliding this week, and none of them sit alone. The Fed meets, AI financing questions are back, market warning signals are flashing across tech and bonds, and gold and silver just took their sharpest pullback in months. Let's start with the one everyone's watching first. The Fed held rates steady at this meeting. Morningstar's July Fed preview, published Monday, says June inflation and employment numbers strengthened the case for holding, even as a fresh jump in oil prices threatened to reignite price pressure. This segment isn't about guessing what the Fed does next, it's about why that next question matters more than today's decision. Inflation is still running above the Fed's 2% target. Oil is climbing again. Tariffs are adding their own push on prices that businesses eventually pass to consumers. Morningstar also notes markets increasingly expect a hawkish tone from the Fed under Kevin Warsh, with the door left open for more rate increases later this year. Analysts expect only minimal color on the internal debate and no real forward guidance, which means the market fills in the blanks on its own. And that gap matters for your money directly. Rate uncertainty doesn't stay inside a policy statement. It moves into borrowing costs, into what gets priced for the next 12 months, into how confident businesses feel taking on new debt. Does that make sense? A hold today doesn't settle where the path leads. It just delays when we find out. Every extra point of uncertainty gets priced somewhere, into mortgages, into corporate bonds, into how much conviction investors have holding riskier assets. So if the cost of money is still an open question, who's already leaning hardest on cheap borrowing right now? Investor margin debt has climbed to record levels. What happens to that leverage if the assumptions underneath it stop holding? With that leverage question still hanging, let's look at the numbers Globalbanking&Finance flagged this week. Investor margin debt, money borrowed against a portfolio to buy more stock, is sitting at a record high right now. Record margin debt usually means one thing once prices turn: forced selling. Brokers often issue margin calls, and clients might sell whatever they can, not whatever they'd prefer. Okay, let me throw a question out there. What does leverage usually do to a portfolio when markets are calm? It often amplifies gains. Nobody complains about that part. But it can also amplify losses right when you have the least cushion to absorb them. That's the mechanics, not a prediction. Now, stack a second pressure on top. The same global banking and finance piece points to long-term Treasury yields sitting above 5%. That number can reach beyond the bond market. Above 5% can raise the cost of capital for companies refinancing debt, for households carrying mortgages, and for the federal government rolling over its own borrowing. Add a third pressure, oil prices climbing again, the same wildcard Morningstar flagged heading into the Fed meeting. Higher oil doesn't always stop at the gas pump. It often feeds straight into inflation readings, and it can raise costs for almost anything that ships, manufactures, or flies. What's worth considering is what if none of these three pressures offset each other? Expensive borrowing, expensive money, expensive energy. What if they stack? This leads me to another question. How sensitive has the system gotten to a surprise? When leverage runs high and capital gets costly, the parts of the market that may be most exposed are the ones leaning hardest on cheap, continuous borrowing to keep growing. And there's one corner of the market leaning on exactly that kind of financing more than almost anywhere else. That's next. Shifting gears from margin debt to the AI money machine itself, Jim Cramer went on CNBC Monday and said he watched 2000 happen live, and he said this doesn't need a sequel. Do any of us? What set him off is a Wall Street Journal report confirmed by CNBC that NVIDIA is discussing a $250 billion backstop for OpenAI, money toward a 10-gigawatt data center campus in Ohio. So what actually is circular financing? Picture a chip maker funding a cloud company, which then turns around and buys chips from that same chip maker. The cash makes a loop, revenue gets booked, but did outside demand ever show up, or did the company just fund its own customer? That loop is exactly what worried people in 1999: vendor financing, supplier credits, deals that inflated growth numbers without a paying customer at the end of the chain. In addition, how much of this expansion assumes capital stays cheap and available? We just spent the last segment on 5% Treasury yields and record margin debt. Raise the cost of money, and every plan built on refinancing later could get tested at once. A dot-com echo isn't proof of a dot-com ending. It's a flag telling you to check what's funding the growth, not just the growth number itself. Gold and silver just pulled back hard from their highs, and that pullback gets interesting. With that in mind, let's turn to metals. This pullback is happening in real time, not somewhere off in the abstract. Economic Times ran a piece today on it. Gold peaked January 29th and has fallen nearly 20%, from 1,75,000 rupees per 10 grams to 1,41,800 rupees. Silver got hit harder, down 45%, from 3,96,000 rupees a kilogram off its high. Reset or reversal? The article calls it a normalization after an excessive run, not a confirmed trend change. The case for reset leans on three things holding steady: central banks still buying, consumer demand still showing up, and the uncertainty we've spent this whole episode on, none of it resolved yet. Okay, someone holding an 8% metals allocation just watched it shrink by a fifth. Do they add or do they wait? Honestly, either answer can be defensible. What matters is whether they know why they hold the position in the first place. And I have to give the other side its due. Treasuries are still yielding north of 5%. Gold pays nothing while you sit on it. That's a real cost, not a footnote. So why hold it at all? Because of what it can do when the things generating that yield come under stress. That's a different job than income. Won't pretend I know if this drawdown extends further. Economic Times isn't calling a bottom, and neither am I. Short-term pullbacks in metals have run longer than people expect before they turned. What a moment like this is actually useful for is smaller: reviewing your allocation, learning how physical ownership works, deciding if a tangible asset fits your plan, and if this is a buying opportunity. Gold is a long-term hold. If that fits with your goals and lifestyle, this pullback could prove to be a buy low, sell high opportunity further down the road. If that's where your head's at, you may be happy to hear that Lear Capital's rolling out Lincoln coins tied to the country's 250th anniversary in 2026. They're struck in 0.9999 fine gold or 0.9999 fine silver. That's 4 nines, higher purity than a lot of other coins on the market. They're official legal tender, and that purity level is what lets them qualify for many self-directed precious metals IRAs. Sizing is fractional, a quarter ounce in gold, a half ounce in silver, so entry cost is lower than a full ounce coin. Why Lincoln for this? He led the country through the Civil War, and that legacy of holding things together under pressure fits a semi-quincentennial theme built around unity. The obverse carries his portrait, "In God We Trust," and the 2026 date. Flip it over, heraldic eagle, a shield marked 250, olive branches, and the years 1776 to 2026. A coin like this could be an ideal way to hold gold. Either way, know exactly why you're holding it and why. So that's the week. A Fed decision that raised more questions than it answered, leverage sitting at record highs, and AI financing deals that echo a bubble we've seen before. The takeaway I'd leave you with: when paper assets all depend on the same set of assumptions holding steady, it's worth asking how much of your holdings depend on nothing else. That's not a case against any asset, it's a case for balance. If you want Lear Capital's research on gold and silver, or to learn more about the new Lincolns, text $$ to 43343. Again, that's $$ to 43343. Thanks for spending your time with me. Leave a review and text $$ to 43343 for your free info. Talk soon.